Okay, so today's agenda, we're going to take a look at the key economic indicators, the global economy, the domestic economy, mergers and acquisitions, other significant economic news, and what's ahead in 2023. And today we're going to talk about the underlying economic assumptions for 2023. So we have a lot of criteria that has come up today. So first of all, we're going to be in for a bumpy road in 2023, and the overall economy will begin to slow later in the first quarter of 2023 and basically contract during the second quarter of the year. And we should see some things turning around latter part of the year, and we'll also see a decline in gross domestic product. Expectations are that we should see a turnaround in the economy moving in the right direction sometime in 2024. Now, a lot of times we talk about recession, people talk about soft and hard landing. So let me kind of give you a real simple view of soft landing. Soft landing is really is the goal of the Federal Reserve when it seeks to raise interest rates enough to stop the economy from overheating and experiencing high inflation without really causing a severe downturn. On the other hand, a hard landing refers to a market economic slowdown or downturn that follows a period of rapid growth that we've seen in our economy, but not in a crash of the market. And often high interest rates could cause the economy to enter a stagnant period, or in this case, a recession. So that's kind of what we're looking at now. In terms of the recession forthcoming, economists really predict that we'll see a moderate recession starting as early as the second quarter. I believe we've already started that as well. Consumer spending will decline, and we'll see job losses escalate in the first and second quarters of this year. Keep in mind, there will be a lot of activity in the market hiring, but there'll all be a lot of layoffs, and I'm going to talk about later in the program. Inflation, which is a concern to everyone, will continue to plague the economy until interest rates impact demand and curtail spending, thus lowering inflation. The Federal Reserve will continue to raise rates somewhere between 25 and 50 basis points over the next several months until they feel comfortable that we're getting inflation under control. And we're going to see falling commodity prices, easing of supply chain shortages, and also an economic slowdown in wage growth as well. And we'll see core inflation should go down as well. Energy prices have really had a significant effect on this country over the last 3 years, really causing a lot of inflation. In terms of consumer spending, the impact or drag from increasing interest rates and weakening employment picture, if you will keep consumption growth in check. And the strength in household balance sheets, along with a boost in real incomes and wages, should cushion an economic downturn. What you have to keep in mind is that 67% of the GDP is predicated on consumer spending, which is very, very significant. And if that slows down, we'll see a continued slowdown in GDP. And of course, consumer savings has taken a big hit in the last 3 years. And debt is across the year, it's continuing to increase as we've seen the latter part of last year. And I said earlier, the labor market is expecting a modest decline in payrolls in the first half of the year as companies escalate increases in layoffs and freezing on hiring. And expect the unemployment rate to be somewhere around 5% or higher throughout the year. In terms of both categories of internal and external demand over the next few quarters, we'll see a stabilizing as the economy continues to slow. In terms of the dollar, economists really forecast that the dollar will remain strong, but could decline against foreign currencies. And many global central banks will take steps to strengthen their currencies through their own monetary policies. And we could see the impact of a slowdown in the dollar value if the recession persists. When we look at supply chain, you can see supply chain delivery times are continuing to improve and trend downward. Transportation costs are going down along with the cost of shipping containers. You may recall months ago, shipping containers were going as much as $30,000 to $31,000. Their prices have dropped significantly, which will be passed on to the consumer in the form of products going to the marketplace. The auto sector is now showing signs of improvement by increased inventories reaching the dealers. And inventories will grow, thus reducing costs to consumers. You'll see more products on the shelf going forward, and production will improve. And services during the year will pick up. as we've seen it before the pandemic. Here's the big kicker, and that is credit card debt concerns. Been a surge in massive credit card debt is a major concern to the banks, and you're going to see them start to tighten down requirements on credit card terms. You'll see in some cases, people's credit values will drop where they'll have less money to spend on the credit cards based upon the affordability indexes. And you'll see basically increased interest rates will negatively affect consumer spending. And then basically they will continue to see the outpacing taking place with credit card debt. And this credit card debt now is even worse than the period of 2008 and 2009 when we had that deep recession several years ago. The housing market, which is concerning everybody on this call, is set for basically a correction. And the market will continue to go through a correction throughout the year as low inventories coupled with high mortgage rates will see a lot of buyers on the sidelines. And economists are predicting in some cases that we could see a value of home price values drop by 5% at least, but nothing to what we saw in the 2008, 2009 timeframe. And it was also a 41% drop in permit activity during 2023, and we'll see it continue throughout 2023 as it was in 2021, 2022. Commercial real estate, essentially interest rates, lease and rental terms will undergo changes as the recession peaks its head. You'll see a lot of companies trying to renegotiate their leases and their rental agreements with their clients. And you'll see a slowdown in commercial real estate may occur when pricing is really going to drive the market. We're also going to see back to the office policies now as the pandemic continues to decline. We'll see more people going back to work periods of time in the office, whether it be 3 or 4 days a week, etc. On the block right now is our major competitor called China. The currency will continue to underperform. Currency depreciation in 2023 will turn around next year. And real estate issues still plague the country and their economy. Their GDP will be lower this year than it was in 2022. And again, as you can read these things in the papers, there's a real concern about the consistent policy with COVID and variances and further lockdowns and the impact on manufacturing and the exporting of products and services throughout the world. Now, I'd like to take a look at some key economic factors that we take a look at every month. We're going to look at the gross domestic product, inflation, unemployment at the federal level, unemployment at the California level, and then the price per barrel of oil. So all of these factors have changed, and I'll bring one up that's some good news here. So in terms of the global GDP forecast right now, it's looking that it went out at 1.8% globally. Now, keep in mind the numbers are still not final because we're going to see changes taking place probably up until March when the numbers are finalized because of some adjustments. The global GDP for this year is around 1.6%, which is down, and that's predicated on softening economies throughout the world. In terms of the United States, you see that 1% growth for 2022. Well, guess what? It was a shock this morning. It just came out with the number. It's now 2.9% for the fourth quarter growth, which is incredible over the 1% that was projected over the last couple of months. So we saw 2.9 for the end of the year. Looking forward to this year, we're looking at a downturn somewhere about 1.5% based on the decline in the economy. Core inflation went out the year in December at 6.5%, and we're looking at all the changes taking place to go out about 4% at the end of 2023. The unemployment rate went out at 3.5% at the federal level. That's the lowest it's been in several years, and it's projected to go up as high as 5% or higher based upon the recession that's been predicted. And then if we look at California went out the end of the year, December, at 4.1% unemployment, and that's projected to go up to about 5% or more by the end of this year. In terms of the price range, oil per barrel, we've seen here that the different parts of the world want to continue to cut back on production to drive the rates up. It's running between $80 and $110 a barrel, and that's based on West Texas Intermediate. So that's kind of where we are with these things. These are all changes that took place since we last met in October. Now, a couple of brief comments about the global economy. Once again, inflation will continue to plague global countries throughout the 2023 timeframe, with the expectation that global countries will enter recession sooner than the United States. And global central banks will see growth decline and unemployment rise in the face of recession. The demand for products and services will contract throughout most of the year. And we're seeing the light at the end of the tunnel until some of the financial tools that are being used will drive inflation down and start changing the economies going forward the latter part of the year. In the Eurozone, last month we saw inflation was at 9.2%, which is significant. And the intent here is to drive it down to 3.6%, hopefully by the end of 2023, based on monetary policies that are being taken by all the banks throughout the global economy. And overall, supply chain is still a concern on a global basis here. China continues to struggle with COVID, and in some cases, they've shut down production lines up and down and so forth, which is having a major impact on the flow of products and services to their constituents. And if you look at China's manufacturing, it's the sharpest decline in 3 years. And we've seen that significantly impacting us. And again, it's based upon what's taking place with COVID in their production facilities throughout China. Canadian headwinds basically we're looking here that suggesting there'll be a downshift forthcoming in their economy. Economists predict a mild recession throughout the year. And with expectations are that they'll be able to drive down inflation in Canada by continuing to raise interest rates by 25 basis points on a periodic monthly basis. And Japan is probably the strongest in the Asian area because it's projected their GDP will soften a little bit during the year. However, experts believe that they've avoided a recession because of one, they've had subdued wages in the marketplace, and two, they've implemented strong monetary policy to deal with their peers. So their economy is still pretty strong and is not going to be subject to the same thing a lot of other countries are facing. Now, taking a look at the United States, let's talk about the domestic economy. As you know, the open market Federal Reserve Committee raised basis points a couple of months ago by 50 points. We'll see an increase probably taking place in early February. Most speculate we'll see an increase of about 25 basis points. And then when we get into March, April, and May, it could be the same thing. And then at some point in time, they may stop raising rates during the year. And it could be, if depending on where we are by the end of the year, we could see a reduction in interest rates. But again, right now, it's still a wild card because we don't have enough data. The bad news here is the wholesale price index inflation rate went up by 7.4% from December of this year versus December of 2021. And that's the products that go to like Macy's and Vaughn's and everything, every place else, it increased by 7.4%. So that means prices are going to continue to increase. What's interesting here with the oil industry, we cut back production in the United States along with other countries around the world, and we're seeing an increase slightly taking place this year. So the U.S. demand for oil is going to increase this year as people go back to work and there's more activity and travel, et cetera. So we're looking at production increasing to 12.34 million barrels a day, and that's up from about 12.3. Not a lot, but it's higher than it was set in 2019. And we'll see what happens. You could expect that possibly later in the year, unless production increases, we're going to see higher gas prices. Store credit cards, as I mentioned earlier, in some cases, rates are being, in some credit cards are up as high as 30% interest rates. It's staggering. Households basically are using credit cards, believe it or not, to pay their weekly and monthly requirements because they're pretty low on either in terms of wages, unemployment, et cetera, having a very hard time. The debt was projected in December to be $351 billion in credit card debt, which is substantial. And again, it's up 15% over the last 2 decades. So it's worse than I said earlier in 2008 and 2009. Mortgage rates, demand plunged last month in the year completely by 13.2%, which is substantial. We'll see it go down this year, but possibly not as much, as we could see a stabilization taking place in mortgage rates later in the year. It's still very volatile. Real estate update real quickly, mortgage rates, as I said, will continue to be volatile. The housing market is set for a correction, and we're already seeing that taking place. Commercial real estate The rates are slowing down. A lot of companies I know in the Bay Area are renegotiating leases and rates right now to try to cut expenses. So looking ahead, let's take a look. So for example, I mentioned inflation. We closed out December at 6.5%, and that'll continue to keep rates high in terms of by the Federal Reserve continuing to move things. Again, the labor market continues to be strong with the creation of new jobs, and in some cases, higher demand for salaries. We're seeing that continue to inch up, which has an effect on inflation. You know, while the number has fallen post-pandemic, we're still seeing a lot of employers beginning to have a freeze on hiring, in some cases, escalating layoffs. In the trade export business, we saw trade exports went out about $252 million, and that's down by $5 billion from October. This is the November timeframe. Keep in mind, a lot of these statistics, they trail by at least a month or two. The trade deficit, good news here is it was down to $61.5 billion in November. That's the lowest level we've seen since September of 2020. And that's on the right course. That's the key. We want to get down that as low as we can. Retail sales took a hit in December as shoppers battle inflation. We saw the rate drop by 1.1% based upon the high yields. And also that's the largest we've seen since decrease since December of 2021. Now let's take a look at the job market. Well, actually, let's see here. Yeah, let's take a look at the so I've got 2 months I want to show you. So first of all, in December, we had a modest amount of jobs created, 223,000, and that's where the unemployment rate dropped down to 3.5%. The real key factors here are health and education, and leisure and hospitality. Both had the strongest gains. And to keep in mind, during the beginning of the pandemic, those sectors got wiped out. So they're coming back with strong. Business and professional services was down. IT, information services, was down. But the good news is the second bullet is construction, which is really critical, was up. And manufacturing was up as well. So those are critical elements for the economy. In November, since we didn't have a meeting in November, I just wanted to quickly share with you, we went out about 263,000 jobs. It's the same areas, again, leisure and hospitality, construction, and health and education were the key areas. And we saw downturns in retail and transportation, et cetera. Now we take a look at the California economy. We had a modest 16,000 jobs were created, and it's now about 4% above pre-pandemic in February of 2020. And again, unemployment went out about 4.1%. We continue to face a problem in California, and that is the lack of truck drivers and also the production of oil and the distribution of oil. And that continues to impact our economy in California. There's not a lot to talk about here, just to look at health and education, added some jobs, and construction again was good with 7,500. And then taking a look at November, just real quickly, they had almost 27,000 jobs were created. Inflation had, the unemployment rate had increased, if you will, to 4.1%. Same thing there, the health and education area and also leisure and hospitality were up. Now, taking a look, for example, if we look at inflation, inflation continues to placate the industry in terms of where we are. It's causing a major problem for us, and that's not going to curtail until we can get interest rates under control. One of the things we talked about earlier is that if you look at the mortgage rates, they closed late last week. They were out about 6.58 in January, late January. They're even a little bit higher right now. But again, the rate continues to modulate all over the place. The manufacturing index is a red flag. The concern is, as I've told you in the past, that it's got to be around 50 basis points or above to be significantly positive. And right now it's at 48.4, which is below, which says we're either in a recession or entering a recession. So that's something we need to watch over the next few months. Factory orders decreased by 1.8% in November, following 3 strong months of increases. So there's a concern about that. Small business confidence level is running at 89.8, and that's below the 100 number that we were at earlier last year. So that's another concern. But you look at consumer confidence, The number went up to 108 from 104 we saw in November. So there's some strong elements about how people are feeling about what's going on, mostly getting over COVID and moving in a different direction. Crude oil prices, I mentioned earlier, they closed around $80.73 about a week ago, and that's up from the 79. So we're running really around $80 a barrel, and hopefully we can stay at that area. And that'll be there based upon the volume and what happens with construction and development of some of the oil fields throughout the United States. Again, keep in mind, if the demand goes up and we don't have enough production, we'll see prices begin to rise as we move into the summer timeframe. The housing starts, single housing starts fell 4.1% last month, which is significant. And again, that's going back to the highest it was since April earlier last year. In the terms of new home sales, if we look at Southern California, first of all, the LA market had the second price drop in the United States in Southern California, as inventory continues to remain high and a lot of people continue to sit on the sidelines. Basically, the sale of homes were down 12.2% from December to the prior November. And again, economic skittishness, the soaring inflation, pricier homes are being frozen and they're staying on the market longer. And again, the surging rates and mortgage rates are keeping people on the sidelines because of the affordability index. Just taking a look at 3 counties in Southern California, Los Angeles, the median prices declined by 4.7% last month, and they're down basically, sales were up by 3% during that time frame, but sales dropped by 45% from December of 2022 through to December of 2021. That's substantial. Same impact in Orange County. Prices rose about 2.9% in Orange County, and we saw that the sales were up by 2.9 as well. However, sales from December of 21 through 22 were down 44%. And the same with San Diego. We saw a decrease in pricing about 1.7%, and they were down about 43%. So the market has taken a major turn, and we'll see what happens as we move into the spring. Existing home sales, again, for the 11th month in a row, we've seen a downturn, hitting the slowest pace we've seen since November of 2010. It's a long time. Basically, in some areas, we saw 34% down from a year ago. Looking at construction spending, the spending in the United States was up by 0.2 of a point, which is good, and we're seeing a rebound taking place, and hopefully we'll see more taking place. Biggest concern in construction has to do with high interest rates and heightening economic uncertainty on the horizon. So we'll see what happens in that area. Usually, looking at the productivity report for the fourth quarter, the data probably won't be out probably until March of this year. Now, the next area, which is really starting to see a lot of activity, is what I call company displacements. So last month, if you will, since we met last time in October, there's close to 250 companies that have had layoffs in the United States. I just want to address a couple of ones that were significant. So first of all, there's a company in the Bay Area called DoorDash. It's an online food ordering company. They laid off 1,250 people. Morgan Stanley, 1,600. Goldman Sachs, 4,000. Micron, 4,800. Salesforce, which is going through a restructuring, 7,300. Amazon, 18,000. The Bank of New York Mellon Corporation, 1,500. Microsoft, 10,000. And Google, 12,000. And I've got a whole bunch of that came out last night. I'm not going to talk about till next month, but it's continuing. And there's been some research that was released within the last 2 days. It said in the last several months, almost 190,000 jobs in the technology sector have been lost. And I'm not sure what period. It could be over the last year and a half. Now let's take a look at mergers and acquisitions. So first of all, experts predict that mergers and acquisitions will have strong activity in 2023, and there'll be substantial activity taking place in the healthcare sector. You know, overall activity is going to increase because think about this, we have relatively flat organic growth in most corporations. And if you're publicly traded, your stock is as good as it was 90 days ago. So you're going to see a lot of activity taking place. And even though interest rates are somewhere around 5%, that's still pretty cheap in terms of buying companies and displacing and making restructuring of the firms happen. So it's still pretty cheap. So some notable acquisitions that just took place. So Hyatt is acquiring a company called Dream Hotels for $125 million. Again, they're expanding their foot into different marketplaces, and that'll take place, and they should close sometime in the first half of the year. Amgen is buying a company called Horizon Therapeutics for almost $28 billion. The company is a therapeutics developer of anti-immune disease treatments. So again, there's an example of a company in the biotech space that's going through mergers. Marathon Oil is acquiring Eagle Ford for $3 billion. Basically, Marathon is an independent oil and gas exploration and production company that extends over 26 countries. And the idea there is they're continuing to focus on other forms of oil extraction, such as shale, et cetera. So that deal is taking place. That's significant. L3 Harris, and there's a couple of folks on the phone that on our call today that work for Viasat. They're buying another company now. It's called Rocketdyne for $4.7 billion. They're located in El Segundo, California. And this is combining talents of about 50,000 employees, continue to drive process improvements, enhance their business operations, and really elevate performance in terms of their critical assets. And as I said, Vista Equity Partners is acquiring a company called Duck Creek for $2.6 billion. This is a Boston company that's involved in SaaS software that provides software technology to property and casualty management. So you're seeing that taking place. And then when we look at manufacturing, there's a US manufacturer is getting $2.5 billion investment from a South Korean conglomerate. And basically they're building a solar manufacturing chain group in Georgia. And this will be in terms of the first largest one, taking advantage of massive tax incentives by the United States government to build out this production in the state of Georgia. So let's take a look at other significant news. I mean, we have a whole bunch of things to talk about in this area. So first of all, Zag Abreg, which is will establish its North American headquarters in Forsyth, North Carolina. The German manufacturing company manufactures ventilation systems, generators, and other equipment, and they'll invest about $100 million to create a facility of about 500,000 square feet, and they'll hire 189 new people to facilitate that company. And Mercedes basically is going to charge the electric car drivers $1,200 a year for fast drive. In other words, they plan to charge owners of its upcoming line of pricey electric cars a subscription fee a year, $1,200, to boost their ability to accelerate quickly. Something that's a novel idea. Black Friday was a very good one for us this year. We saw $9.2 billion in shopping that took place that Friday, and that's about 2.5% higher than we saw a year ago. Now, here's the key. The US banks are tightening lending standards, raising the risk of recession. So what we're seeing now is they're restricting a lot of credit cards and looking at tightening up on terms of the process and evaluations of credit cards, because there's too much credit out in the marketplace. So you're going to see that taking place as we go through the year to try to reduce that and not have to write off a lot of credit card debt. If you're familiar with Blackstone, they limited withdrawals from their commercial account by $125 billion as investors rush to exit the program. Basically, it was a surge in requests because investors want to get their hands on their cash and concerns about the long-term health of commercial real estate property. So they basically closed the doors on that a couple of months ago. I mentioned earlier about the issues in China. Manufacturing orders from China to the United States is down 40%, and they're bracing for more delays in goods and services. And again, this is the result of canceled sailings of container ships and rollover exports by ocean carriers. So we're going to see that having an impact on our economy. DHL is another company that's buying 2,000 electric vehicles to their fleet, and they want to have those in place by the end of the year, again, removing those that are run on gasoline and other types of fuel. This will be a $7 billion investment by the company. And then we have a Taiwanese manufacturing company, which is basically triple their investment in a company in Phoenix, Arizona, where they're building another facility site for the area of building more semiconductors. Remember, we talked last year that there's at least 5 or 6 companies building companies throughout the United States for manufacturing semiconductor chips to be able to be more done in the United States versus relying on Taiwan. Now, Microsoft and Viasat announced a partnership to deliver internet access to underserved communities globally. And this will affect about 5 million people around the world. This should be done by 2025. Meta Corporation, which is formerly known as Facebook, just was fined $414 million for evasion of privacy problems. So what happened here is that they were fined for privacy violations and banned the company from forcing users to personalize ads based on their online activity. Now, the good news is that automobile inventories are coming back. However, auto sales last year were down 8%, and that's the lowest level since 2011. And for those of you that have a Twitter account, 235 million email addresses were hacked. And this happened before Musk bought the company. I'm not sure whether he knew about it at the time, but that's a big impact. Now, Pepsi-Cola has decided to eliminate Sierra Mist, which I like. And in terms, they want to be more competitive with Coca-Cola, so they're coming out with a new product called Steri. And Steri will come out sometime this summer to compete again with Coca-Cola. Wells Fargo, which is really one of the top mortgage lenders in the country, is retreating from that industry. Basically, they've decided to take a step back, and they've announced a significant shift in only focusing on mortgages for their existing customers and some minority owners instead of acquiring new customers in that area. Now, Tesla had an announcement last week, which is interesting. They've cut the price of a Model Y and a Model S car by 20%. And so that's a lot of people are upset about that bought those cars for full price over the last few years. And Bed Bath & Beyond continues to struggle. Unfortunately, they've closed 62 more stores, and there's 8 of them in California and 2 in San Diego specifically. You look at Amazon, they're starting something called Logistics as a Service offering to leverage bloated warehouse blueprints. So what they're doing now is they're going out and constructing deals with companies that are independent retailers to start using warehouses for Amazon support, which is pretty good. Again, that's another source of revenue. When we look at the retail spaces, if you will, since the Great Crisis started, retail vacancies has really reached a new low as retail fundamentals remain surprisingly strong. Keep in mind, with a lot of the stores leaving, for example, in San Diego, there's a whole area, it's in Oceanside, where a lot of stores went away, such as, I can't remember all of them, but anyway, instead what they've done is you've got people like the Cheesecake Factory and other restaurants are moving into the malls. So you're seeing a new utilization of space taking place to keep the malls moving. So we're going to see that taking place. Now, for those of you who are familiar with a company called NortonLifeLock, they just had thousands of customers breached. Their accounts were compromised about 2 weeks ago, and their passwords and et cetera data was all breached on notice. And so that's taking place as we speak. So that kind of gives you an idea what's been taking place around the country over the last couple of months since we last met. So what I'd like to do now is open it up for questions and answers.